Welcome to Financial Reporting Conversations, brought to you by Basford Consulting.
We're here to make the unknowns and knowns of accounting, auditing and climate standards known, so you can avoid the blind-threading mistakes and do financial reporting better.
Each episode will unpack what the standards really say, what they mean in practice.
Whether you're a preparer, auditor, director or litigator, our aim is to help you get it right. Fraud triangle actually means and how it helps us understand financial reporting fraud. I know you can talk about this topic for hours, but let's keep this episode to around 30 minutes. And if we don't cover everything, we'll pick it up next time. So let's start with the beginning. When I first heard of the fraud triangle, it makes me think of the Bermuda Triangle. What is the fraud triangle, and does it have to do with things randomly disappearing?
I'm not sure whether it verily has things to do with investors' money randomly disappearing. So the fraud triangle, and this is concept within auditing standards and a well-known concept of fraud. So you've got the pressure and the incentives to commit financial reporting fraud being one point of the triangle, the opportunity to commit financial reporting fraud being another point of the triangle, and the final corner being rationalisation. Why it was okay to commit financial reporting fraud, because so if you've got those 3 points together, you will likely have financial reporting fraud, and you're very likely never going to, there's always going to be pressure to make results good. There's always pressures and incentives. So the art to dealing with the fraud triangle is focus on reducing the opportunities and creating a culture that cannot rationalize committing financial reporting fraud.
Thanks, Wayne. That's very interesting concepts there. And before we dive deeper into those 3 points of the triangle, let's do some quick yes or no answers. You can go on for ages, but just yes or no. Is the auditor the one with the ultimate responsibility to prevent and detect financial reporting fraud?
No.
Does financial reporting fraud include disclosures?
Yes.
Is fraud all about just stealing assets?
No.
Is the most likely person to commit financial reporting fraud the CFO?
No.
Is an auditor expected to respond to fraud?
Yes.
And last question, who is the key individual to prevent financial reporting fraud within an organization?
The audit committee chair or the chairman of the board.
Okay, thanks for those. Good that you just stick to yes or no answers. Now you can talk. Now you've got permission to talk a bit more. And
just
let's look at
on.
Not quite, but you can explain a bit more. One of the aspects of the fraud triangle that you've mentioned is pressure. What are the pressures?
Well, the number one pressure everybody works under is meeting budget. And all the accountants, all the auditors know in this world, we are conditioned to meet budget. We are competitive people. We are high performers. What's the biggest pressure? Meet budget. Don't miss budget. You then go, if you miss budget, well, you won't be promoted. You won't have a bonus. There's massive pressures to hide mistakes. There's bigger corporate pressures. We need to deliver a particular result. We need to achieve a particular turnover. We need to achieve a particular profit number. We need to be profitable. We need to have a particular banking ratio. So there's pressures imposed on a corporate organization that filter down. We need to get new borrowing. We need to renew our borrowing. We need to make sure that we don't breach our banking covenants. We need to make head office targets or else we'll be closed down. So those are the key pressures that filter down to a lot of people within an organization.
One thing I can think of is you've investor forecast and meeting those investor forecasts so that your share price would not collapse if you're not meeting those profit forecasts that you've sort of communicated to the market already.
It becomes a team commitment that you personally might not own shares. You personally might not have share options, but you now know the important thing. We have made this announcement. The market expectation is this particular number, and that pressure is just driven through. And then you actually remember, I'm obsessed with the power of the budget or the evilness of the budget. You know that the market expects you to have revenue growth. You know that the market would expect you to have a 5% revenue growth on year on year. That then gets turned into the annual budget. So the budget needs to be 5% growth because that's what the market expects. And then everything is driven by the revenue target, the budget, and that is the pressure that just goes to everybody in the organization. Every sales guy, every manufacturing guy, every project guy is pressurized to meet that market expectation.
And when you mention about mistakes, about hiding mistakes, what sort of mistakes do people try to hide?
Now, again, when I'm looking at the person most likely to commit financial reporting fraud or have an incentive to commit financial reporting fraud, it's the CEO. They have made a bad mistake to buy that subsidiary. They've made a bad mistake to invest in that new factory. They've made a bad mistake to invest in that new mine, that new exploration asset, that new service line. They're incentivized not to tell the board, not to tell their investors that really we overpaid for that subsidiary. So there's pressure on the CEO to hide mistakes. When you're looking at project managers, just projects in general, construction projects, they made a mistake. They didn't tender correctly. They missed an element out of the tender, or they've just not managed the project properly. It's going out of control. It's cost overruns. But don't you worry. I don't want to tell everybody that I've made a mistake. There's pressure there for me to keep my job and to hide my mistake. You equally will get with people choose inventory lines. People decide I'm going to buy that pink widget this year and everybody's going to buy pink widgets. And that turns out in hindsight, I've spent all that money on inventory that nobody wanted to buy. I want to hide that slow moving inventory. I told you I would have this project delivered. I told you it would only cost you $1 million to create this new AI app and it will be ready by the end of the year. I made a mistake. It's not going to be ready by the end of the year and it's going to cost a lot more money than $1 million to get to market. Shall I hide my mistake? It's human nature and it's business, but that's hiding mistakes.
Yeah, so it sounds like, pressure, it's that are like around with us every day, like pressure for meeting targets, budgets, and, investor expectations to mistakes, like we all can get it wrong at some point.
Business is about taking risks. And guess what? We all make the bad decision. We all make mistakes. And that creates a massive amount of pressure for even those people you'd have thought were honest, would want to be honest. This creates a pressure to create financial reporting fraud.
we've touched on some of the pressures. What about incentives? What are some incentives for financial reporting fraud?
Well, a key incentive is just stay in your job. Everybody's got an incentive to stay employed because they've got mortgages, they've got school fees, they've got holidays that they want to do. So that's an incentive. But you then get the incentive is sorry.
Bucket lists to tick off that needs money.
Your bucket list to tick off. Your partner's bucket list to kick off. The incentive is to have a happy home life and to keep on building like your partner's dreams rather than necessarily your own dreams. But that's an incentive to stay married. But you've got the easy one, the short-term incentives that potentially auditors put too much focus on. It's to earn a bonus. You meet budget, you will earn a bonus. You do own options. We all know conceptually we incentivize our staff to work harder by giving them share option schemes. To be honest, which works, they're working, but you are also giving them an incentive to commit financial reporting fraud. You will have situations, particularly with newly acquired subsidiaries, whereby key managers, key CEOs are actually on earnouts, and so they are all incentivized to make as much profit, EBITDA, according to the earnout arrangement, the deferred consideration earnout situation. So there's a number of incentives that form part of that point of the fraud triangle.
So there's a lot of personal incentives too, to keep your own job, to pay mortgage, to have a happy marriage, to keep your partner happy, and it's all quite linked to our sort of remuneration structure and our arrangements that are quite common. What about so we've got the pressures and we talked about the incentives. So to commit a fraud, I think there's that needs to be opportunities. What are the opportunities that a person might have or a CEO might have?
Remember, it's different person that has the different opportunities. So you have estimates. Classically, there's an estimate. What's my opportunity to be biased in that estimate? So you can have impairment estimates. What's the recoverable amount? And I can be overly optimistic. Now, who's the person that makes that estimate? Is it financial controller? Is it a CEO? Is it a divisional financial controller? Or actually, does it work with the CEO and tying it into unrealistic budgets and hopeful budgets? So estimates of net realizable value, estimates of cost to complete. Classically, I'm the project manager and it's all going wrong and I don't want to tell everybody it's going to go wrong. There's an estimate on cost to complete, estimate on percentage of completion. You've then got weak controls. So how can I improve revenue? I can structure a sales contract to really front load the revenue. And I can do all sorts of things to get revenue early, to raise an invoice. I can promise sales support, product support to that customer. I can do all sorts of deals with the customer, and I just structure a contract to achieve as much revenue as I want to front load. I can pre-bill. I can raise invoices early. I can put different times on my timesheet. So, and that comes through weak internal control. There's not processes in place to make sure IFRS 15 is properly dealt with. I can hide invoices. I can hide costs. I can keep invoices in my drawer. I can hide liabilities. I can phone suppliers up and say, please don't raise an invoice this month, only raise an invoice after the auditors have gone. I can actually capitalize expenses. That really isn't an expense. That's part of property, plant, and equipment. That's part of an intangible. That's part of a development cost that is going to be capitalized. An easy one for the accountants, and I do emphasize it's not always the accountants that commit financial reporting fraud, but it is a journal. I can actually just create a journal to do anything that goes debit asset, credit profit. A massive opportunity for financial reporting fraud is related parties. If I've got related parties, I can use them to inflate revenue, support values. So those are the opportunities. And nobody asked me questions. Opportunities are, I've got a weak internal control environment. I've got an audit committee that doesn't ask the right questions. I've got an external audit that doesn't ask the right questions. Therefore, I'm pretty convinced I won't get caught. And, you know, the opportunities, I can do it and I won't get caught.
If you're finding this discussion useful, please take a moment to click like, subscribe, and share. It helps others in the financial reporting community discover financial reporting conversations and keeps you up to date with every new episode. So it sounds like having good internal controls is very key to reducing those opportunities, to minimize those opportunities for fraud.
And it's the phrase that I come up with, it's actually having the correct culture. If an organization lacks the correct culture, financial reporting fraud will happen. And having weak internal controls is actually the consequence of having the bad culture. If you're happy not to do things properly, if you're happy not to have proper controls over revenue recognition, have completeness of liabilities, proper controls and review of estimates, that is because your culture's wrong. And that, the phrase, in the intro thing, I believe the key role is the audit committee chair. The key role is to make sure the entity has the appropriate culture and will not tolerate financial reporting fraud, will not treat it as a game. Integrity into financial reporting above, we need to meet budget. But it's all culture, you see.
Yeah. So we've got point 1 of the triangle is pressure incentives. Point 2 of the triangle is opportunities. Now, the last bit of that triangle is rationalization. What can you explain this last point?
Rationalization is all sorts of things. I didn't do anything wrong. There was no harm. I was just doing my bit to meet budget. It's just a timing thing anyway. I just wanted to recognize sales in June rather than recognize sales in July. And it rationalizes it. Well, so what? It's just a game. My job is to make budget. I made budget. I knew it would come good. I knew I'd be able to recover that project. I knew I'd be able to get those sales anyway. You rationalize it. And a lot of it, we meet budget. We're part of the team. I did my bit for the team. We were all desperate to achieve budget. And I came up with that really clever little trick in the...
I'm there to save contract. Everyone. Is that a rationalization? Save everyone's jobs?
If I'd have told the truth, if I'd have actually put the right numbers in that VIU DCF, well, we'd have impaired it. And if we'd have impaired it, if we'd have showed everybody just how bad it was, and we all knew it was bad, If we'd have told everybody the truth, well, the share price would have collapsed. We wouldn't have got that shares away. We wouldn't have got the new borrowing, and me and 1,000 other people would now be looking for a job. I think I did the right thing by not telling the truth. There's your rationalisation. And the fourth triangle: pressure, opportunity, rationalisation. You will have financial reporting fraud. Internal control is there with the taking out the opportunity, but opportunity and rationalisation goes back to its culture. If you have a culture, no, I just want to get it right. This is, financial reporting is meant to report accurately, honestly, the performance of the entity. Yes, it's not gone well, but our job is to reflect how it went, not how we'd hoped it would go or how we hope it will get better in the future. But that's a culture that comes from the tone at the top.
So that was a very good, robust discussion on the fraud triangle and the 3 points. Back to finance, do individuals know they're committing financial reporting fraud? Do they realize?
Some people will realize that they're playing a game. And I'm not sure whether if I looked them in the face and said, that's financial reporting fraud, you have materially misled your investors, you have not complied with AASB 136, you've not complied with AASB 15, you have breached the Corporations Act, you have committed fraud.
So they think they're just playing with numbers. Is that?
It's numbers. It's numbers.
It's just a game.
My job, my everything is to meet budget. And I've been a financial controller in the past. What's the job of a financial controller? The job is to control numbers and meet budget. I was just doing my job. And, the auditors, it's a game. The auditors are there. The auditors should have spotted if I was really doing anything fraudulent, the auditors should have spotted it. It's a game, and I won that game this year. And I look forward to next year's audit as another game as I try and hide the real numbers from you. Most people don't think they've committed financial reporting fraud.
In our discussion so far, you sort of mentioned that the audit committee chair is a very important person and plays quite a significant role as part of good governance of an organization and preventing fraud. Why is the audit committee chair so important?
If you look at conceptually the role of the audit committee, it is to ensure the financial report is appropriate, is prepared in accordance with accounting standards, and the audit committee is usually there to make sure that the company has the appropriate internal controls. So all the responsibility sits with the audit chair. Have we got the appropriate code of conduct? Do we tell people they can't play games? Have we got procedures that say, if you make an estimate, it must be reasonable and supportable? It must be questioned. We must have a policy of recognising revenue in accordance with IFRS 15. And the audit committee chair and the audit committee need to ask the right questions and need to ask the right questions of management, the CEOs, the sales directors. Is this in accordance with accounting standards? Have you been biased? Could there be another answer to this? Are you sailing close to the edge? Have you had this checked by your auditor? Have you had this checked by somebody who knows the accounting standards? Those are the questions the audit committee should be asking of management, of the CEO. Their board packs should be, tell me this is right. Tell me this is in accordance with the accounting standards. Tell me these estimates are supportable. And ultimately, it goes back to culture. The audit committee needs to create the culture within the organization.
And does the audit committee chair need to be very knowledgeable about accounting standards to ask the right questions?
Whether the individual needs to be, I would say no. But they do need access to support and knowledge of people that are knowledgeable of the accounting standards. And that could be the CFO. You can reasonably say, okay, I want a paper to explain whether this is in line with an accounting standard. Please present to the audit committee a paper that says why we think it's appropriate under 15, under IS 36. And then the audit committee says, and have you had that checked by your auditor? Have you had that checked by somebody else? So going back to your question, I don't think the audit committee chair needs to be an expert on accounting standards. Somebody on the audit committee needs to be familiar with the key principles of accounting standards, not accounting, not banking, not tax, but actually accounting standards. And I would say, I said this at a recent Cancer presentation I gave, an audit committee chair needs to think like an auditor, needs to understand the risks of material risk misstatement, needs to be constantly questioning what could go wrong, and then ticking off they've thought about what could go wrong and they've asked the right questions to, I knew what could go wrong. I've asked these questions. I've asked these questions of the CEO. I've asked these questions of the CFO. I've asked these questions of the external auditor. And I, as the audit committee chair, who are actually going to tell the board that these financial statements are prepared in accordance with accounting standards, I have got the basis for that resolution I'm going to pass up to the main board.
So I know I'm watching the time and we are getting close to our 30 minutes. So let's wrap up here for today. That was a great overview of the fraud triangle and all the different angles from pressure and incentives to opportunities and rationalization. And we've also touched on how for financial reporting fraud actually happens and also the importance of the audit committee chair plays. So we've covered a lot today, like I said, but there's still more to explore. I think we're going to talk about emerging markets, which would add a whole new layer of complexity in financial reporting.
If we talk about emerging markets, which we should, it's a completely separate episode of the China hustle, all sorts of problems. So emerging markets is taking fraud and financial reporting fraud to a whole new level.
Yeah, so stay tuned for that episode, but we'll leave it here for now. And thanks to our listeners for tuning in.
Thanks for listening to Financial Reporting Conversations. For guidance on applying accounting and auditing standards or to access our online training programs, please visit basfordconsulting.com.
Don't forget to like, subscribe, and share this episode with your colleagues and contacts. We'll see you next time where we make the unknowns in financial reporting known.